This is like, we picked up some short questions from Leases. This is number 176. This is from your BPP practice kit. The objective of IFRS 16 Leases, it is to prescribe the appropriate accounting treatment and required disclosures in relation to leases. Which two of the following are among the criteria set out in IFRS 16 for an arrangement to be classified as a lease? So we said, if you remember from previous lesson, we said that under IFRS 16, you don't have finance lease or operating lease. What you have is a lease or a service contract. And lease essentially is the same which you previously called finance lease. So lease is something which makes you an owner, like a partial owner. So which two are the criteria? So we start like this. Number one, the lessee has the right to substantially all of the economic benefits from the use of asset. Has the right to substantially all of, not all of them, but substantially. So it says that which are the criteria which are classified as a lease. This is correct. The lease term is substantially for all of the economic life of the asset. This is not true. This is false. Because even if there is an asset which has a 10 years life, but you take only 5 years, so still it is a lease. So it says the lease term is for all of the economic life of the asset. This was under IS 17. It is not a criteria under IFRS 16. So this is wrong. The agreement concern as identified assets which can be substituted, which cannot be substituted. Yes, this is what we said, that it must be a specified asset. Like I was giving you example that you say that, you know, the office number 4 on the 5th floor or office number 4 on the 4th floor. So specified asset, or maybe a vehicle number this and that. So it has to be a specific asset. And the lessor has the right to direct the use of the asset. No. Under the lease contract, two things we said, two things you should remember. In order to call it a lease, two criteria I gave in last lesson. Number one, it has to be a specified asset. And number two, you have an uninterrupted use. You have the control. You can direct how to use the asset. If the lessor can tell you how to use the asset, then it is not a lease. Because if the lessor can dictate you how to use the asset, then you are not the partial owner of the asset. You don't have control. There is no lease. So in order to have a lease, you should be having full control of the asset for the lease period, how to use it, and the asset should be specified. So we can say that our answer is your option number A and C. Your answer options are A and C for this thing. So that's a theoretical question, short thing. A and C. These are the two correct options. Then we move to number 177. So let's read it together and see. Tomalet sold an item of plant for $50 million on 1st April 2004. Let's first read the question. It says, what amount will be shown as income from this transaction in the statement of profit or loss for the year ended 30th September 2004? Income from the transaction in your P&L for the year 30th September 2004. Okay. So Tomalet sold an item of plant 50 million on 1st April 2004. The plant had a carrying amount of 40 million at that date, at the date of sale, which was charged to cost of sales. So a 40 million plant you are selling for 50. On the same date, Tomalet entered into an agreement to lease back the plant for the next 5 years, being the estimated remaining life of the plant, at a cost of 14 million per annum, payable annually in arrears. An arrangement of this type is normally deemed to have a financing cost of 10% per annum. Tomalet retained the rights to direct the use and retain substantially all the remaining benefits from the plant. So what should you show? So here what is happening? The topic here, actually, there is one topic which I will give more explanation, and that is called sale and leaseback. You call sale and leaseback. In sale and leaseback, we will discuss it in more detail I mean, we discussed the topic leasing, but this is one topic I will explain few more things. In sale and leaseback in general, what happens that you own some asset, but you sell your asset and then you get back the same asset on rental because you need cash. For example, you are living in a house which is $100,000. You need cash. What you do, you sell your house to a bank or to a leasing company. And because you still want to live in the same house, you get that back on rental and start living there and start paying the rent. So you actually have sold the asset and then you are using it back. That is called sale and lease back. Now, in this question, what they are asking you, they ask you that what should be shown as income in the statement of P&L. So what we understand here that it is selling it, the asset was 40 million. It is selling it for 50 million. So apparently it looks like that he's making a $10 million profit or gain because a 40 million thing is being sold for 40 million, for 50 million. And then he's getting it back on lease that he said that I would start paying $14 million as lease rental per year. And there is some finance cost. Anyways, so now they ask you how much income should be shown. So probably some of the students might think that we would be showing $10 million as income because a $40 million asset is being sold for 50 million. But that's not true. Actually, there is no income. You should be writing here that there is no income. There is no income, nil. Why there is no income? Because pay attention here. It says that Tomlet retained the rights to direct the use and retained substantially all the remaining benefit of from the plant. So it is not transferring the right of usage. So it is like, not selling the asset, because when you sell something, you transfer the control, you transfer the ownership. You are not selling it actually. It looks like that you are just borrowing $50 million and you are putting an asset as a collateral. So there is no income because if you have sold the asset, you should have transferred the right to control, but you are keeping the right, the direct the use of the asset. You are keeping the control with yourself. So we don't consider it. So it is not under the scope of leasing now anymore. So you would say that there is no profit, there is no income, it is nil. So this is where you should pay attention, that who has the control. If control is still with him, you don't consider it as a sale transaction, because in a sale transaction, control should be transferred. So it's not a revenue transaction anymore. Then comes your number 178. 178.
Sorry to interrupt, sir. So then what do we have to write in the box? Like answer 0, nil. What do we have to write there?
Nil, N-I-L, 0.
NIL, because these computers, there's a big problem.
No,
Like
no,
if we
write
answer
down
like in commas or in points,
no, write down NIL, N-I-L, nil.
That's it. The answer will be correct then.
Yeah.
We don't have to write 0 then?
No. Makes no difference. Either you write 0 or you write down nil. Makes no difference.
And because computer reads only, I think, digital numbers, that's why I'm asking.
No. It's not the case. It's not the case.
It's not the case?
No.
Exactly. Okay.
178. Again, it is coming from a sale and leaseback thing. So it says a sale and leaseback transaction, which means you sold your asset and got back again on lease, involves the sale of an asset and the leasing back of the same asset. If the arrangement meets the IFRS 15 criteria, IFRS 15 criteria means the revenue criteria. To be recognized as a sale, how should any profit on the sale be treated? How do you treat the profit? So number one, recognition whole amount of profit immediately in profit or loss. This is not the case. You cannot recognize all of the profit because there is a time duration of 3 year, 4 year. So whatever profit has been made, it should be amortized over the period. Defer profit and amortize over the lease term. Recognize profit relating to right of use of retained, and recognize proportion relating to right of use of transferred. This is the answer. Recognize proportion relating to right of use transferred. Uh, what does that mean? Listen, first thing is that let's analyze these two questions. The previous question, we said that we cannot recognize any profit. We said nil because it did not, criteria for IFRS 15. This particular one, it says that it meets the criteria for IFRS 15. So if there is any profit, let's suppose 10 million, just like in previous example. So if you see that there is a profit, how should you show this profit? I mean, you made a $10 million profit. How should you show this profit? Now, considering that it is meeting the criteria. So if it is meeting the criteria, one thing is clear that I must recognize it. I must show it. I will not say nil like in previous one, because in previous one, you had the control with you. And we said that because you had the control, you did not transfer the control. So it does not meet the criteria of IFRS 15. Here it does. So if it is meeting the criteria, then what should happen? You've got four options, and I will explain them one by one. Number one, it says recognize whole amount of profit immediately in profit or loss. This is not the answer because very straightforward. You are leasing it back for 2 year, 3 year, 4 year. So that profit belongs to that period. You cannot recognize everything in year one. So number one is straight away the wrong thing. Number two, it says defer profit and amortize over the lease term. Whatever is the profit, you defer it and you split it over the lease period. This is also not correct because you do not defer it or amortize it over the lease period. What you do that, you have to recognize, this is your true answer, what I tell you. Option number D, it says that recognize proportion of relating to right of use transferred. Now, what does that mean, right of use transferred? Recognize proportion relating to right of use transferred. Let me explain you it technically. Let's suppose the asset has a life of 10 years, okay? But you made a lease for a period of 4 years. So it means that this asset which you sold, this asset has a life of 10 years. You sold it to someone, but then you said that please give me the lease for 4 years. After 4 years, I will not be using it, but 4 years I will use it. So it means that what you retained and what you transferred. So there is a period, we call it now right of use retained. Two terminologies we will see, and we say right of use transferred. So right of use retained is 4 years and right of use transferred is 6 years. Okay. So what you retained is 4 years and what you transferred is 6 years. So this asset, you are giving it for a 6 years lease term. So this is the right of use, like, the total benefit, you should split it on this period, not on the 4 years or 5 years lease period. You should be talking about the right of use transferred. Whatever is the right which you have given, you have transferred, that you have to proportion your profit based on that. So it says recognize proportion relating to right of use of transferred. Whatever right of use you have transferred, this is the portion which you will recognize, because this is not the case. Revenue belongs to right of use of transferred. This is you are keeping with yourself. What you are transferring for this period, you will recognize the revenue. Basit, Basit,
Yes, sir.
do you
Yes,
understand?
sir. Yes, sir, I got it.
Okay. Then we move to 179. It says during the year ended 30th September 2004, Hyper entered into two lease transactions. Okay, you please read it. I will also read it, and then we do together. Please read it in 2 minutes. Got it? Now they ask us what we should be charging, what amount in total would be charged to Hyper statement of profit or loss for the year ended 30th September. So what comes to your P&L? Now, you know, in your P&L, what you are going to write down. You're going to write down in P&L your interest cost if you have paid any. So we have to write down, you know, charge in P&L. Charge in P&L means what goes as expense in the income statement. So what goes as expense should be your lease interest, which you have paid, or probably if there is any depreciation of lease asset. So these are the two things which you usually charge to the income statement. I mean, if you have paid any interest, that is like finance cost, that goes to the lease. And if there is any depreciation of right of use asset, that goes there. So considering this thing, what we can do now, first let's see that what is happening. It says that during 30th September 2004, Hyper entered into two lease transactions on 1st October 2003. So first you pay attention, where is your end of the year? Your end of year here, end of year is 30th September 2004. And the beginning of the year is 1st October 2003. So we are talking about full 1 year. It is not about 6 months or 8 months. So first thing you always pay attention, are we talking about months or full year? So we are talking about a full year. We made a payment of 90,000, being the first of 5 equal annual payments of lease on an item of plant which has a 5-year useful life. The lease has an implicit interest rate. Your interest rate on the lease balance is 10%. And the initial measurement of the right of use asset and the lease liability is 340. So your lease liability is 340,000 and lease asset is also 340,000. I explained to you last time that this lease right of use asset or lease liability, this actually is the present value of your future payments. So what you have to pay in future, actually, you have to pay, let's suppose 90,000, and you have to pay 90,000 for the next 5 years. So these are 5 installments of 90, 90, 90, 90. This one you already have paid, and now you have to pay 4 more. So if you pay attention, the value, they say that your total lease liability today is only 340,000. Okay, this is the present value. It may look more. If you make a total of that, it looks like 360,000. But they calculated the present value of lease liability is 340,000. The total present value. Okay, like 90, 90, 90, 90 in 5 years, it makes you a total of 450, total of 450,000. But you said that the present value of that is only 340,000 because you did discounting. So this is the present value. So now we understand. So how I should be doing, I just explained you this thing, that what is the present value. So I would say that, you know, on 01/10/2003. This is the beginning of the year. And my lease liability is 340,000. And on the same day, we made, first payment, which is equal to 90,000. So your lease liability remains as 250,000. So this is your liability. So on 1st of October, actually your lease liability is 250,000. On this 250,000, you have to pay finance cost. Finance cost you have to pay here. And that finance cost will be at 10%, because your finance cost, they told you in the lease that it is 10%. So 250,000 into 10%, this goes to the balance sheet as your finance cost. This is the first thing. That's quite clear. Number two, what you will charge to your books would be depreciation of right of use asset. So how much is right of use asset? You would say initial measurement. Initial measurement of right of use asset would be 340,000, because they told you that right of use asset is also 340,000. And then you say depreciation, which is on 5 years, because life is 5 years. So your depreciation would be 68,000. This number will also go to the financial statements. And then this is about the first asset. The second asset, it says on 1st August 2004, a payment of 18,000 for a 9-month lease. Now that is called a short period lease, a 9-month lease, a lease which is less than 1 year. It's a short period lease. The total value is 18,000. I would call it short-term lease. Short-term lease. And the value of the short-term lease is 18,000 total, but this is in 9 months. But when did you get it? That's very important. You got it in 1st October. You got it on, 1st August. On 1st August, you are getting it. So within this year, I would say that cost during 30th of September 03, this first year, because this we got on 1st October 2003, this we are getting on 1st of October 2004. You've got short-term lease on 01/10/2004. I'm sorry, not 01/08. So here I will only charge 2 months, okay? 2 months, like my year is ending on 30th of September 2004. My year is ending on 30th of September 2004. I got the asset on 1st of August 2004. So only 2 months, 2 months out of 9 months. So you should be doing it like 2 divided by 9, 2 divided by 9. So I would say 18,000 multiplied by 2 divided by 9, because in this financial year only 2 months land in, like this is not the full 9 months. Remaining 7 months will be charged in the next period. So this is 4,000. So we would say that total charge to P&L with respect to leases would be 25 plus 68 and plus 4. These are the 3 numbers. So 97,000 you should be charging to your lease arrangement. The total cost, this 96,000, it includes the interest cost on long-term lease, the depreciation of right of use assets, and the short-term lease proportion. Okay, now we do question number 180. It says on 1st January 2006, Platinum entered into a lease agreement. So please pay attention on dates, 1st January 2006. The initial lease liability was 360,000. Uh, when I say initial lease liability 360,000, it means the present value of all the future lease payments. And the terms of lease were a deposit of 120,000 payable on 1st January 2006. Like on the same day, you have to make a deposit of 120,000 and 3 further installments of 100,000 payable on 31st December 2006. So beginning of the year in 2006, on there is an equipment which you want to get, which has a present value 360. When you get the equipment on the same day, you pay 120, and then end of the same year, like 31st December 2006, you pay 100K, next year 100K, and then further 100K. The rate of interest implicit in the lease is 12%. Interest rate is 12%. What will be the amount of finance charge arising from this lease, which will be charged to profit or loss for 31st December 2007? So they ask you the interest cost, but not for the year one. This is actually your year two, 2007. So just pay attention that they're asking you to calculate interest for the second year. Quite simple. What you should be saying, you should say that your initial liability, let me write down here the dates. It is 01/01/2006. Always go with the dates, otherwise you will be confused. Initial liability is 360,000, and you have initial deposit. And initial deposit is also given on the same date. And how much is that? It is, I think, 120,000. So it means that this is the amount. This is my, let me call it net initial liability for interest calculation. Based on this, I will calculate my interest, because the total liability, total present value was 360. 120 I already have given. So definitely I'm not going to give interest on this 120. I will be giving interest on the amount which I owe, and I owe only 240,000. Then I have to charge my interest. I would say, 31st 12/2006, 1 year later, my finance cost should be on 12%, and 12% of 240,000 becomes like this, 28,800. And then on 31st of December, they told you my lease payment, because it said in the question that you pay on 31st December one more lease payment. So we pay here 100,000 more, and we say here, I would call it lease liability, and this is on, let's call it, 01/01/2007. So when you are putting the dates, it will be clear to you what you are doing. So on 1st January 2007, you've got a lease liability of 168,800. And then on 31st of December, you should again make a finance cost of 12%. 1 year has finished. So 168 times 12%, it gives you 2256. And this is your finance cost, because what they ask you in question, they asked you that what amount will be charged as the finance charge for 31st December 2007. So on 31st December 2007, our finance cost is 2256. Let's suppose, okay, question is finished here, okay? This is that. Question is finished. Let's suppose they ask you that what is the lease liability at 31st December 2007. Let's suppose if they ask us. So it should be simple, because you will make a lease payment here of minus 100,000, and you would make a total, and you will say that 89,000 is my lease liability. So this is my lease liability, okay? So let me do this question for you. Question is solved. I just want to show you something. I want to show you something. So this is your lease liability on which date? This is your lease liability on 31st December 2006. Okay. I would call it closing lease liability. Now, if I move on, okay, this is by the way, I'm sorry, this is 2007. These all dates are 2007. Now, if I move on to 01/01/2008, how much will be my lease liability? I would call it my opening lease liability. And this would be the same amount. This is my opening lease liability, like the 31st December 2007. So when I move into next year, it is again the same amount. And then in this year, I have to add my finance cost. I would say my finance cost for 2008. On 31st December 2008, your finance cost you have to charge. How much? 12%. So 12%. And then you calculate here this much multiplied by this much. It comes like this. And then you make a payment. Like every year you are making a payment. You will say lease payment. And if you remember, the lease payment was 100,000. You put here 100,000. And now when you make a total of these three numbers, like you've got here opening liability, this is the interest expense, and this is what you pay. You make a total, and what do you see? It says 257. So this 257 actually is the rounding off. Effectively, it is finished. This 257 has just come in with some rounding because they told us 360,000 straight. Probably there is something. So when you will make this table on last year, you will become, actually you should be getting a 0. But sometime we don't get 0. So because there is some rounding off difference. So why it has happened? This is what you say, the effect of implicit interest rate. They use the word here, implicit interest rate. The rate of interest implicit in the lease. Implicit in the lease means that this is the rate which will increase your lease liability with interest costs. Then you will decrease payments, increase interest, decrease payment, increase interest. Ultimately, it will make it 0. So implicit interest rate is that interest rate with which you are calculating interest and paying interest, and ultimately it should make it 0. I mean, you put any number here except then 12, you put here 13%. Things will change. Things will change because 13% is not the implicit. Effective rate or implicit rate is this much. So anyways, our question was only until here. Few things we just did more than required. I mean, they asked us only how much is the interest cost in 2007. We said it is 20,256. So that is done. Any question you want to ask? So that's a short question number 182. It says that Fino incurred initial direct cost of $20,000 and received lease incentives from the manufacturer totaling $7,000. So if you remember, so it is direct incurred initial direct cost of 20,000. This is not your lease payment. This actually is what? Probably you took some property and you need to do some kind of repair work. So you incurred this money as a repair expense. Direct cost means the money which you spent on the property. Like you got a house on rent or an office on rent and it needs some repair work. So you spent 20,000 and received lease incentive, and you got some lease incentive from the manufacturer totaling 7,000. So you said that, see, I'm spending 20K, some part of that you should contribute. So he's giving you 7,000. After 4 years, it will have to dismantle the plant at an estimated discounted cost of 15,000. So estimated discounted cost of 15,000. So what is the initial measurement of the right of use of asset? Initial measurement of the right of use of asset. Okay. So right of use of assets. So which other values do we have? I mean, what is the present value of lease payment? Did I put up the question complete from the book? Because where is the value of the asset? This is I'm spending extra. So 20,000 will be added, 7 will be subtracted, and this 15 will be added. But added to what? I mean, let me go back to the book. Did I pick up the question from the book correctly? Okay. Now, if you see the book, do you people see the book? Do you see the book, Basit?
Yes, sir.
Okay, so this data, actually I picked up this 182. This is coming from this data. We need to see the data. So the asset, it says that on 1st April 2007, Fino increased the operating capacity of its plant on the recommendation of the finance director. Fino entered into an agreement, leased the payment plant from manufacturer. The initial measurement of the lease liability is 350. So this is your lease liability. The lease required 4 annual payments of 100K each commencing on 1st April 2007. The rate of interest implicit is 10%. The lease does not transfer ownership of plant to the Fino. Okay. So it says over what period should Fino depreciate the right of use of asset? Over what period? You should be depreciating it over the period of the lease contract. So how much is the lead from the period of the contract?
4 years.
You will compare. Now there are two things. One is the life of the asset, and one is the lease period. Maybe the asset has a life of 10 years, but your lease period is only 3 years, and you should take shorter period, shorter of both. Whichever is short, that you would take. Okay. I mean, asset maybe have a 10 years life, but my lease contract is for 3 years. So I have to depreciate my right of use asset only over a period of 3 years. So answer should be shorter of both. So from the commencement of the lease to the end of the lease term, or from the commencement of lease to the end of the lease life, from the commencement of the lease to the longer, no, to the shorter. D is the answer. From the commencement of the lease to the shorter of the end of the lease. So if your lease is 3 years and the end of the plant is 10 years, you should take the short period. So D should be the answer. So this is 181. It was quite simple theoretical thing. Then this is 182, which we were trying to do on Excel file. So it says that you incurred some direct cost, which means that something which you spent on renovation. You got 7,000 back as your incentive. It should be subtracted. This should be added. And you have to restore. So that's the provision you need to create. It also must be added. So how do we get the numbers? So what we have here, the value of the lease is 350 plus I put 20K for some kind of construction minus I got 7K from the lessor plus I have to remove the asset at 15. So your answer should be 350 plus 20, 370, 385 and 378. So 378,000 should be your answer. 378,000. Answer choice should be B. That was also quite simple, not difficult. Okay. Now we come to, I'll skip this 183, 184. These are rather easy. Okay, next is provision. So we stop here. We were only wanted to do this one, the lease questions. Provision we'll do in another session.